This is Terry Ryder from Hotspotting with this week's edition of my Good News Bulletin. And today we saw the announcement of the federal government's ongoing plans for support measures like JobKeeper and JobSeeker, extending them beyond the end of September. Thankfully, because journalists and the nation's gaggle of chattering economists have been having a bit of a feeding frenzy on speculation about the so-called September cliff. Now, according to this rather ridiculous theory, which comes direct from the kindergarten of economic analysis, at the end of September, the federal government and the major banks would switch off all support, and as a result, the economy would crash and property prices would fall off a cliff. There have been screaming headlines about the so-called September cliff pretty much every day for a number of weeks. But of course, that was never going to happen like that. So today, as was always intended, the federal government announced its plans for the next phase of the program, extending it beyond the original September deadline. And in simple terms, JobKeeper and JobSeeker will continue, at least until March next year, but will be more targeted. And there's been generally favourable feedback about the plan from the real estate industry. First of all, we had an announcement from the Property Investment Professionals of Australia, otherwise known as PIPA, which says that the extension of the JobKeeper wage subsidy program will provide a further, what it calls, airbag for the Australian economy. And PIPA chairman Peter Kalouzos says the wage subsidy extension will help soften the economic blow from the pandemic. He says a similar strategy of stimulus initiatives was employed during the GFC that ultimately resulted in the Australian economy avoiding a recession. Muster Builders Australia says the extension of the JobKeeper scheme is the right move for the building and construction industry and will help boost confidence in the industry, the economy and the community generally. CEO of Master Builders Australia, Danita Warren, says there's no doubt that JobKeeper continues to be a lifeline for thousands of small builders and tradies, as well as many in the building supply chain. Meanwhile, housing sentiment lifted in the June quarter after restrictions started to ease in most parts of the nation. The ME Quarterly Property Sentiment Report finds that property sentiment has risen by 6 percentage points to 35%, but remains below the recent high of 39% recorded in the first 3 months of the year. Worries about how COVID-19 would affect property values have eased. According to this survey, the proportion of those expecting house prices to fall in the next 12 months has dropped by 10 percentage points. Now only 31% expect prices to fall. ME General Manager of Home Loans, Andrew Bartolo, says sentiment started to improve as soon as restrictions were lifted across most states and territories. And Bartolo says the rebound in confidence is a natural reaction to improving COVID-19 case numbers when we conducted the survey. Today, the weekly report on property prices from SQM Research was published, and it indicates that nationally, house prices rose 0.5% in the past month and apartment prices rose 0.6%. In terms of house prices in the individual capital cities, there were increases in the past month in Sydney, Brisbane and Hobart, and no change in Perth, and there were decreases in Melbourne, Adelaide, Canberra and Darwin. With apartments, prices rose in the past month in Melbourne, Brisbane, Adelaide, Canberra and Hobart. In annual terms, house prices have risen over the past year in all capital cities except Darwin. Nationally, house prices are up 6.4% over the past year, and in the capital cities, the annual rise on average has been 9.4%. Now, you may have read in mainstream media that rents are falling in Australia. That's because most of our major media comes out of Sydney and Melbourne, and there's a tendency to assume that what's happening in the two biggest cities is happening everywhere across Australia. But that's very seldom the case, and it's not the case with rents. Rents have certainly dropped in the past month in both Sydney and Melbourne, but according to SQM Research, rents for houses have risen in Brisbane, Perth, Adelaide, Darwin and Hobart. And nationally, house rents have risen 1.6% in the past month, but apartment rents have dropped 2.1%, which makes sense because most of the locations where vacancies have risen are markets dominated by apartments, including the big city CBDs and tourism meccas like Surfers Paradise. Now, one of the city markets that has continued to pump strongly during the pandemic is Adelaide. Adelaide has dealt with the pandemic better than almost everywhere else in Australia, and that has allowed its highly consistent property market to keep on thriving. And in the latest edition of the Price Predictor Index, produced by Hotspotting, which was published today, I reveal that 2/3 of Adelaide suburbs have recorded growth in their property prices over the past year. And that was confirmed by other research published this week, which found that property values have grown in more than 2/3 of Adelaide suburbs in the first 6 months of 2020, defying the COVID-19 slumps in the larger Australian cities. According to Point Data's Lay of the Land report, Adelaide metropolitan real estate values increased by 1.1% in the 3 months to the end of May and 0.4% for the month of May. And its report says South Australia seems to be faring better in both property prices and building activity compared to other states. Melbourne's housing market returned to lockdown, of course, with almost half the city's scheduled auctions being withdrawn last week, but Sydney continued relatively normally and recorded its highest preliminary clearance rate in 2 months. In Sydney, the initial read on clearances jumped to 69%, up from 63% a week earlier, which was subsequently lowered to 62% as more results came in. Included in the results, a 4-bedroom house in upmarket Vaucluse sold $200,000 above the reserve at $5.7 million. Brisbane posted a clearance rate of almost 60%, which is high for Brisbane, where auctions are relatively scarce. Adelaide's reading was 64%, and Perth reported a preliminary clearance rate of 40%. Now, that ME Quarterly Property Sentiment Report I referred to earlier found that first home buyers are highly active. And why not? With interest rates ultra low and the level of government assistance at an all-time high for first timers. The survey found that first home buyers are looking for bargains in the current climate, and also that many are considering a move out of the capital cities to get into the housing market, a trend which continues to gather pace for both first home buyers and also other types of buyers across the country. According to the survey, 82% of first home buyers say they're bargain hunting. And just over half of them say they plan to get into the housing market in the next 12 months, the highest of any group in the survey and up 9 percentage points from the previous survey. 60% of first home buyers say they would consider buying in a regional area to save money and to have a better lifestyle, compared with 45% of respondents overall. ME General Manager for Home Loans Andrew Bartolo says the introduction of remote and more flexible working arrangements has influenced people's thinking about where they can live. Low interest rates are also having an influence, with 75% of first home buyers saying that low rates have made buying a property more attractive. Now, I want to focus again on the way media reports real estate issues, especially some sections of the media. As I've observed previously, Fairfax newspapers like the Australian Financial Review have a very negative and often sensational approach to reporting residential real estate. Now, a recent report in the Financial Review highlighted CBD vacancy rates and the decrease in rents for inner city apartments. It reported Sydney CBD rents have fallen sharply, prompting fears that more landlords will be forced to sell for a loss. Now, they sourced this information from the latest monthly report on vacancy rates around Australia from SQM Research. But being the Australian Financial Review, they reported only the most negative information in that report and ignored all the positives. So what did the actual report show? It showed that vacancy rates had fallen, and in other words improved, in all of the 8 capital cities in June, and that the national vacancy rate had dropped from 2.5% in May to 2.2% in June. 5 of the 8 capital cities now have vacancy rates below 1.5%, which is very tight. Perth, Adelaide, Canberra, Darwin and Hobart, while Brisbane has a vacancy rate of 2.4%. Sydney is the only city with a vacancy rate above 3%. And that's remarkably positive, considering we're in the middle of a pandemic. But the Financial Review typically focused on the only negative in the SQM Research report, which was the high vacancy levels in big city CBDs. And that, I think, is sad and pathetic, but typical. But to finish on a more positive note, Let's return to those figures earlier in the broadcast on prices. The latest price data from SQM Research published today shows that house prices right now are higher than they were a year ago in 7 of the 8 capital cities. Darwin's the only exception. Sydney is 13% higher than a year ago, while Hobart remains up 11%, and Melbourne house prices are almost 10% higher than last year. Brisbane's up 5%, while Perth, Adelaide and Canberra have all grown by between 2% and 3%. The capital city average is an annual rise of 9.4%, and that, in the circumstances, I think, is remarkable. And before I go, check out the new Winter 2020 edition of the Price Predict Index, which I published today on the hotspotting.com.au website. Bye for now.